Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of TJ Stearns Inc., your resource, Chicagoland, for proactive guidance with your money, with your investments, for your financial and retirement future is Tim Stearns, CFP, here each and every week on the Protect and Grow radio program. And Tim, today we are going to be talking about a topic that is of particular interest to me, as well as I think everyone I have ever talked to, which is paying less in taxes, planning for a tax-free retirement. Those words in combination just sound so great together. Just a nice ring, Tim. And well, you're here to give us the guidance. Is that even possible?
Well, I think this is on front of mind for everybody. You know, you get done with the nice holidays with your family, New Year's Eve, etc. And then, believe it or not, you start already thinking about April 15th. We talk a lot about this in our retirement classes because what do we do then from about January to April 15th as we Monday morning quarterback our last year. You know, shoulda, coulda, woulda. Done different things. And that's why, this is a great topic today to talk about, how to try to mitigate some taxes and how to get ahead of this during the year so that you're not money quarterbacking the last year.
Well, if you would like that kind of proactive guidance to identify efficient strategies to control, minimize, or even eliminate unnecessary tax, pick up the phone and give a call to your resource, ladies and gentlemen, for that kind of proactive planning guidance for the Protect and Grow blueprint for your retirement. He is Tim Stearns, CFP, 800-640-2256, 800-640-2256, the number to call. There is, Tim, I kind of joked tongue in cheek about everybody hating taxes. Universal consensus, though. Taxes stink. Nobody likes paying them. But we also all realize that we have to because they didn't hire those 80,000 additional IRS agents for nothing, right? So let's talk about how we have been taught and trained to take care of taxes, and then where are those opportunities to do better? We should consider the tax implications of every dollar that we save for retirement and the effect that it will have on us in retirement very, very carefully. We should consider that. But Tim, a lot of times we're taught really to put it out of sight, out of mind, and then deal with it later. That's kind of the status quo paradigm for tax planning for retirement.
Well, we were brought up, right, that we need to, save for a rainy day. So the biggest rainy day would be retirement. So we're taught, from the word go, when you get into the real world, is to put money away, defer it, and defer it, and defer it until you take it out when you're over 59 and a half or when you retire. And my gosh, besides your house, that's your biggest asset is your retirement funds. And they've never been taxed by the IRS. Luckily, we've had the ability now in the last, 10 to 15 years to do Roth 401ks and that type of thing. But even the profit sharing component there, you're not paying taxes on. And that's how your company works to get the write-off from you. So, how can we do this a little bit better? I told my son, Jake, when he got his first job, make sure you sign up for their Roth 401k. That's absolutely huge. And so those are the things that we try to preach to people is maybe pay the taxes today under the current tax laws until they change and then revisit it then.
I'm glad you bring up the Roth 401k early on in this conversation, Tim, because this is something that is a little bit more of a newer evolution with the 401ks. In fact, still not all 401ks offer the ability, the opportunity for Roth contributions. But I think there's a lot of misunderstandings about Roth 401ks. A lot of people are under the impression that if they choose the Roth 401k, their company's not going to match. That is not the case, correct? No. You still get the match.
Right. Well, it's funny you bring that up. I was working with a organization and the business manager told me, I said, are you going to offer a 401k option with Roth. And he said, oh, I don't know if we want that liability. And I said to him, the liability you're going to have is not by not offering it at all, because that should be someone's choice, whether they want to pay taxes today or tomorrow. So that being said, either way, whether you put money on the Roth side of a 401k or the normal pre-tax 401k that we've done our whole lives, you still get the match. Dollar for dollar, whatever you used to get, you'll still get. But the portion of the Roth is then after-tax dollars, and it can build for down the road when you are retired. That money, when you pull it out, will be tax-free.
Now, like you said, though, your company, in fact, is transitioning a tax liability onto you with their match.
Right.
And everybody uses the terminology free money. It's not free money because there's a tax that's associated with it down the road. Still, always try to capture the match, but the company is nice enough to offer the match, not nice enough to pay the tax on their matched dollars. So your money would go into one side, the Roth 401k. Right. Their money would go into the tax deferred, but don't worry, because they're going to keep track of those separate amounts for you. It's not like you have to do a whole lot of extra record keeping. You just have to choose whether to pay taxes now while you're earning a paycheck or pay taxes later in retirement. And Tim, for the better part of more than a generation, we've been given the choice and option to delay and defer and pay those taxes later in retirement. And many of us have taken advantage, but is really that the best way to save? And I think a lot goes into answering that question, right? A lot of the calculations and a lot of the projections and assumptions about what tax rates are now and into the future and what our tax bracket and earnings are. That is what you go through as you are helping somebody decide what the best path is for themselves and moving forward in their savings efforts, correct?
Well, we talk about the income allocation plan, and part of that plan obviously entails working with our CPA here to figure out what the tax bill will be down the road. A lot of people say to me, well, I deferred the taxes in my 401k because I'll be in a lower tax bracket. And then you get down to the brass tacks of doing what their expenses are and that type of thing. And the amount of money that they're going to be living on, it might go down a little bit, but not exorbitantly where you're not in the same tax bracket or even in that region, right? So that being said, what else do we have coming up? In 2025, the current tax laws are going to be sunsetting or expiring. So they're going to have new tax laws. And I've asked everyone to a person in our retirement classes, what do you think taxes are going to do in the future? Everyone gives me the thumbs up. Exactly. And they're not excited about
not a good thing. Thumbs up. No, the fact that taxes are going up. For those of you not watching the podcast, listening on the radio, that thumbs up was not a yay, A-okay. That was taxes are probably rising in the future. Now, that's just one man's opinion here, myself speaking for me. But Tim, as you've said, shared with everybody else as well.
Right. I don't know anyone who thinks it's going to go down. We have a huge federal deficit. We're spending more and more money on things that maybe we shouldn't be. And someone's going to get that tax bill, whether it's my kids, my grandkids, or my great grandkids. Someone's going to be paying this hockey stick of a deficit. So why not take advantage of some of these things right now when you could do Roth 401ks, or guess what? Roth conversions. We have the software that can actually do a tax estimator over your lifetime, what you're going to be paying for RMDs, required minimum distributions, what then you will be paying again if you reinvest that money into the market. And lastly, what your kids or your beneficiary, whoever that is, if it's not spousal, what they'll be paying in taxes. So those are three brackets that people need to see. I ran a plan for a gentleman the other day. He was a retired Chicago firefighter, and he had about $700,000 in his deferred comp. And there's about a $400,000 tax bill by him just remaining the case that he had used to be. So meaning he was still going to stay in this, what they call 457, a deferred comp. If he didn't do some Roth conversions under the current tax laws, $400,000 worth of taxes over his lifetime. So we showed him a way to kind of mitigate those taxes. No one wants to pay more than their fair share. So why not take care of it and get ahead of it?
Again, if you would like to see that tax estimator, that projection for what your tax liability on your retirement accounts looks like over your lifetime and retirement timeline, pick up the phone, give a call. Tim Stearns, CFP, will run those numbers for you and help you to identify where there may be efficient, effective strategies to control, reduce, minimize, or even eliminate unnecessary taxes, allowing you to keep more of your money. That's a goal for everyone. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. And Tim, unfortunately, this is not something that many people have seen or addressed in their planning. The way we think about taxes is tax preparation is actually historical. Looking back at last year, what you're talking about is a more proactive tax planning approach, a forward-looking approach to controlling taxes.
Right. So what people normally do is they do tax preparation, right? So after the year is gone, they are looking back and going, oh, geez, we're going to owe, or maybe we get even a refund. But even in the refund case, you gave too much money to the federal government. And we all know they manage their money so well. I'm being tongue in cheek on that as well.
Indeed.
So why not get ahead of it and do some tax planning? So in January would be a great time. You've got, a couple of weeks into the year, maybe at most, that you could sit down with a CPA and kind of see what can we do for the next year to kind of mitigate some taxes. Does it make sense for us to be part of a Roth 401k? Does it make sense to do some Roth conversions? If your advisor is not talking to you about Roth conversions, when the income taxes are so low that they've been in years, then you're missing out on an opportunity. And at the bare minimum, give us a call and we can take a look at what the opportunity looks like for you. It might not be for everybody, but it is for most. And I would say to give us a call.
Again, 800-640-2256, 800-640-2256. Efficient tax planning, time after time, is shown to be one of the things most desired by savers, investors, proactive planners that they are not receiving guidance on. Tim Stearns and his team there at TJ Stearns Inc. do provide that guidance, along with the Protect and Grow written retirement income plan. You've got to talk income. You've got to talk taxes with it. You've got to document your plan. That is the Protect and Grow plan, ladies and gentlemen. Protect is keep as much of your money as possible. Let's minimize those taxes on those retirement accounts. And if you've built up a large retirement account balance, congratulate yourself, but also recognize the potential issue that is. Tim, we've had who has been called America's leading IRA expert by the Wall Street Journal, by PBS, Ed Slott, here on the program previously, and he called those tax-deferred retirement dollars, your 401k, your IRA, a ticking tax time bomb. The projections that you run, the tax estimator, that diffuses the bomb. The strategies that you help people to identify is what helps us to not have that ticking tax time bomb, to go ahead and make sure that we are keeping as much of our money as possible. Again, ladies and gentlemen, if you would like that Protect and Grow plan, pick up the phone now, give a call, 800-640-2256. That's 800-640-2256. And Tim, Ed's description is pretty visual, pretty apt. I mean, that's about correct. A lot of people get really surprised by the explosion of taxes that result from their 401ks and IRAs when they retire.
Well, one of the things that we do in our class is we'll show someone $1 million, in a 401k or IRA, what doesn't matter what it is, it's never been taxed, right? Mm-hmm. And show them exactly, or, we ask the class, how much of this money in my IRA is mine? And the class will say, 100% of it. Well, no, Uncle Sam hasn't got his fingers into there yet. And if I live outside the state of Illinois, some states tax the income from an IRA as well. So you're looking at how much money am I actually taking home? And after $1 million, it's usually around, maybe $750,000. And that's, a big chunk of change. So why not start to help with that? Even if you're 60 something years old, you can still, Social Security Administration says you'll live to be, 85 if you're a male, 88 if you're a female. You could be helping your wife out. You could be helping yourself out. by actually, doing some Roth conversions that could grow for years and years, that when you're taking out, it won't hurt you with Medicare, the IRMA, the Medicare surcharge that they charge us now if we make too much money in retirement. There's a whole host of reasons to do it, and at least explore it and give us a call.
800-640-2256. That's 800-640-2256. Once again, your Protect and Grow written retirement income plan with that proactive tax guidance to identify strategies to allow you to be more efficient, eliminate, minimize, reduce unnecessary taxes into and through retirement. 800-640-2256, 800-640-2256. So Tim, let's run through some of the more and in some cases, some lesser well-known options for controlling taxes. I think there's this perception that there are tax secrets that only the rich and wealthy can utilize, but the tax code is the same across the board. It's just we've got to understand where there are these opportunities in the tax code, and there are actually many. You've talked about one here, Roths, Roth IRAs, Roth 401ks, Roth contributions, conversions. All of these are a way to control and have tax-free money for our retirement and financial future.
Well, yeah, that's one of them. Another one would be using an HSA. If you're currently working, that can build up money that you could pay using truly tax-free dollars. You could be doing qualified charitable distributions out of your IRA that go right to a charity, so you don't get taxed. We have a woman that we have as a client that we set up a charitable remainder trust. And what she's doing is she's taking her required minimum distributions, paying them into a life insurance policy, which is then extrapolating her wealth tax-free into this charity that she wants. Her choice is a church. Yours can be whatever nonprofit that you want to help out. Another one would be, you have grandchildren out there. When you're doing your required minimum distribution, pay the taxes on it, maybe put it into a 529 program, which would then make that money grow tax-free. And if it's used for college, all that money goes to the child's benefit. There's also another one that we really like, and that is the life insurance plans out there. My wife and I have a plan where we pay in money every year into it. We're doing it for 10 years. It's going to give me tax-free dollars if I want to pull out the money down the road after it's grown, right? I instantly have a death benefit, of course. And then lastly, we have a hybrid long-term care policy that if I can't do two of my activities of daily living, or if I'm cognitively impaired, I can easily take out 25% of that death benefit and use it for my care each year, 25% of that tax-free. So these are things that we're looking to do with ourselves personally. So why not look into some things like that?
There are lots of opportunities out there, ladies and gentlemen. Again, these are not secrets that are exclusive, that can only be utilized or accessed by the uber ultra wealthy among us. These are practical strategies that proactive savers and investors utilize all the time and take advantage of to be as efficient as possible with keeping as much of our money as possible. And unfortunately, a lot of these are overlooked in the conversations about your investment portfolio and your financial progress, the actual keeping and utilization of as much of our money as possible, because taxes are one of our largest known expenses. It's not what you make, it's what you keep. It's not what you have, it's what you get to spend out of it. And taxes are typically the largest thing standing in the middle. So go over these strategies with an experienced, qualified professional, with a certified financial planning professional, Tim Stern, CFP, and identify which of these strategies, maybe a combination of several of them, will help to improve your financial outlook, minimize your tax bill and outlook. 800-640-2256. That's 800-640-2256. It's all part of the Protect and Grow planning process, the written blueprint for your retirement income. And Tim, I know that there are a couple other opportunities for some tax advantages with non-retirement accounts. And this is sort of where we start to get into the minutia of, well, what types of strategies are specifically right for which dollars in our account. But if we've invested non-retirement dollars, then there's stepped up cost basis that we need to understand. There are capital gains that we need to understand. There's different investment options that some can be tax advantaged. We hear a lot about, tax-free municipal bonds. Are you giving proactive guidance, not just on retirement dollars, but on investment portfolios like that for tax efficiency as well?
We have a great muni bond fund that has a daily stop loss on it. That is excellent. It grows tax deferred. It's not taxable when you pull it out, et cetera. Having a stop loss in this volatile interest rate environment is also huge. So yes, definitely. We're looking into that for our clients. Also analyzing, we're seeing a lot of older people are, maybe wearing down out there. They might have Alzheimer's and that type of thing. And when we're looking at their estates, because their kids are our clients, looking at, the stepped up cost basis they can get from, stocks that they might have owned in the family forever. That's another thing. The investments can be actually taxed at when that person passes, and they get a stepped up basis. So the capital gain actually goes to the deceased and not, you, which is nice. There are certain political parties out there have talked about getting away from that. So that's something else to look at. I want to stay in the middle here.
Yeah, but they use those tax opportunities to their own advantage as well. So I sort of have some skepticism that those will ever go away, Tim.
I don't disagree with that. It seems like both sides are pretty wealthy. The other thing is, with the 1031, you can take your primary residence. So, all these are codes, right? The 401k, 457, 403bs.
Well, Tim, I know there's a lot that we're talking about, different topics here, and each one of these may apply in different situations. But another big one is real estate. I know your clients on many occasions have had real estate as part of their total financial picture, their wealth and investment portfolio. And there are some specific tax opportunities with real estate that we need to consider carefully as well, correct?
Right. You're speaking of like a 1031 exchange. So if you have investment properties and let's say you're selling them in the Chicagoland area to maybe do something down in Florida, that seems to be a hot topic nowadays, especially this time of year in our office.
Yeah.
Yeah, right. I wonder why, right? So, but that's a great opportunity to move your money from something that you've made money up here, tax-free, over to a new investment property, and hopefully a warmer climate. So that's one of them. There's different areas that we're looking at for our clients. And I think, the bottom line is give us a call. We can go through some of those opportunities. I'm seeing a lot of people who got reduced in force coming back to consulting, right? So they have the ability to open up their own SEP IRA, which is kind of like their own 401k, like for a single person. And what you're able to do there is you can put a heck of a lot more money than just an IRA or your 401k even back then. And you're getting all the benefits of that for yourself. So this is some of the stuff that we're seeing out there.
Well, I mean, we've covered a huge amount of information and different strategies and different opportunities on today's program. The topic of today's show, ladies and gentlemen, tax efficiency, planning for a tax-free retirement, minimizing taxes, the guidance that people are looking for. Investors are seeking the guidance on how to be more efficient with taxes to pay less of them. And if that is what you're looking for, give a call to your guide, certified financial planning professional, Tim Stearns, CFP, Chicagoland's resource, 800-640-2256. That's 800-640-2256. Get that Protect and Grow written retirement income plan. The tax efficient strategies are included as part of that. And again, 800-640-2256 gets you a time to speak with Tim. No cost, no obligation to sit down and get that plan put together or review and evaluate your current investment portfolios to see if there are any opportunities to be more tax efficient. There are opportunities even amongst turbulent and difficult markets. Right now might be a fantastic time to look at tax efficiencies. And Tim, when it all is said and done, that written retirement income plan, the Protect and Grow plan, will also help us to lay out an order of operations of when we should enact certain strategies, because there is an optimal way to access certain types of accounts. There is a proper order of operations with our money.
Well, just like when you're doing a math problem, if you don't use the proper order of operations, you come up to the wrong answer. I would agree with that being the same as when you're trying to do tax planning, and not tax preparation, right? Tax planning. So you're getting ahead of it so that, down the road, you don't have a huge ticking time bomb.
Yeah. And for the sake of time, Tim, here real quick, a lot of people worried about estate taxes. Now, currently, the level for estate taxes is awful high, probably not going to impact nearly as many people as are worried about it. But what a lot of people don't realize is that a lot of us are leaving a huge amount of income tax behind for our beneficiaries as part of our inheritance. And regardless, if we're facing an estate tax issue or we just have the income tax issue, it still deserves attention and proper planning so we understand what those tax implications are.
Right. And having an estate planner, attorney on staff helps with that as well. So these are things, and remember, the federal estate tax is also going to sunset at the end of 2025. And we'll probably see a lot of changes there where it's going to be reduced. So they come after the upper middle class, which is a lot of our listeners. So these are things that we need to be aware of and try to mitigate ahead of it.
Well, again, if you would like some help in planning, if you would like to put together that written retirement income plan, the Protect and Grow plan for your retirement, protecting your nest egg, growing your financial legacy, making sure that you have the correct order of operations and tax efficiencies in place, pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256, or visit online, tjstearns.com, tjstearns.com for Tim Stearns, CFP, your resource, ladies and gentlemen, and the written Protect and Grow retirement income plan. 800-640-2256. Tim, always great conversation here with you on the program. Thank you for being our resource.
Appreciate it, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.